Hello and welcome to BQ Prime. You're watching Q3 earnings with BQ, and my guest today is Sunil Sapre, ED and CFO at Persistent Systems. Mr. Sapre, thank you very much for joining us on BQ. You got a good set of numbers in the third quarter, beating the street estimates. Can you take us through what is the drivers for that 3.5% growth on a CC basis, quarter on quarter?
Yeah, sure. Firstly, thank you, Sajid, for having me. Yes, it was a good quarter amid the challenging environment we are in. This 3.5% growth, as you would have seen, comprises of 3% growth on the services side of the business and 8.6% growth on the IP side of the business. Now, if you look at the services business, this quarter happens to be seasonal with furloughs and the lesser number of billing days due to holidays, both in India as well as US. But despite these headwinds, we have been able to grow at 3%, essentially because of the multiple order wins over the last several quarters where the engagements have been ramping up. And as you know, this has happened in a situation where there is definitely macro playing on the minds of customers. So there is a need to work very, very closely with the customers, not necessarily waiting for the funnel to build up on its own, but work closely with the clients and proactively build what is going to help them meet the business challenges as they see them. And last but not the least, the investments that went into 21 and 22 when the industry had a tailwind. There is an increasing expectation from clients to demonstrate the internal ROI on these investments. So companies like us do also have an opportunity to work closely and help clients to optimize the journey to the cloud, digital transformation, or cloud remediation, whichever terms are used. But this is the reality, really the reason why we could actually navigate through this and come out with decent set of numbers.
You've been growing at a healthy rate on a year-to-year basis and quarter-to-quarter basis. Do you see any challenges coming in Q4? And given the run rate that you are at now, roughly around $761 million for the 9 months, are you looking to exit the year at 1 billion top line?
Yeah, absolutely. Over the last several quarters, the momentum build-up that we have been working on. So, essentially, you look at little one or two levels of data points that we share, the TCV and ACV bookings. So that is something which is the way in which we are trying to work, both the new ACV bookings, the book-to-bill ratio, and how our, TCV to ACV ratio. With TCV ACV ratio, we are working on mainly to improve the revenue per account, the long-term nature of the deals, which can provide us the predictability and sustainability. So the whole approach is we have fair amount of number of customers. Given the nature of the business we operate, if you look at the ISV side of the business, there is a definitely situation that we work with several clients on an offshore model. So the number of accounts that we have are quite significant. We are now working on how we can use this to make these accounts multi-service accounts, particularly in the context of competencies that we have acquired in the last couple of quarters on Microsoft as well as Google Cloud side. And on the Amazon, and as you know, we have very strong relationship with IBM and Salesforce. So that gives us a full spectrum of the cloud ecosystem that clients are trying to optimize. Most clients work with multi-cloud environment. So there are, you can say, various opportunities which we are trying to use to fire multiple engines to help the revenue to grow. And we'll have to be at it. I don't think the market is going to be so easy over the next several quarters, as well as US will pass through, these challenging times. But being grounded, staying very close to customers and working with them is our simple right now, focus.
What about the EBIT margins? We've seen consistently going up quarter on quarter for the last 6 quarters at least. At 15.4%, what should be your aspirational EBIT margin range, if I may ask? And do you see that heading about 20 could be easier for you?
So, in EBIT margin, actually, there are three areas where we are working on a sustained basis, which is where you're seeing, consistently the margin coming up. I mean, at a point in time, we had gone down all the way to 10% or sub 10% kind of numbers. From there, we have come a long way, and there is definitely three areas. The first one, of course, the revenue optimization, the using the client portfolio that we have to improve the revenue per client. The second thing is that you would have observed in Persistent's journey that we had a large dependence on lateral hires, and fresher intake was not that high. Now, what happened during 21 and first half of 22, where there was significant, crunch in the talent market, adequate number of laterals were not available to fulfill the growth that we were seeing and the orders that we were having on hand to fulfill. We last year took that call, and in Q4 of last year and Q1 of this year, we onboarded 3,000 plus freshers. So this was a significant number, which now is coming handy, that after a couple of quarters when they get trained, we are able to deploy them on billable projects. So if you see this quarter, our lateral addition was only 122 in terms of the headcount. We already had created capacity, which we are now deploying. So this becomes another important margin lever going forward. We believe that the margins, which are now at 15.4% on an ongoing basis, we would look at increasing them by say 100 to 150 basis points in the medium term. And yes, the long-term aspiration definitely is to reach, attain an increase of about 250 to 300 basis points.
You're still saying that around 19 to 20% is a long-term goal which you have there.
I would say more like 18 and a half on the EBIT side. Yeah, EBITDA, of course, would be at 20 kind of levels. But the thing is that when we are growing very fast, we are at a nature of opportunities such that we will also be required to invest in building competencies. And while we had taken a bit of pause on the acquisitions, if we again look for tuck-in acquisitions, particularly to ensure that we can, fill the gaps in competencies wherever we see them instead of building from scratch. So that is where some investment will happen, which comes back in form of amortization. As you see, the, way EBITDA to EBIT happens is there is this hit from amortization that happens.
That's
so I'm
true.
seeing building all of that, directionally, that is what 100 to 150 in the medium term. And then, as we scale further, the economies of scale should also start helping us to optimize the SG&A. So EBITDA 20 maybe it's not that easy to get to that level. But yes, EBITDA directionally, definitely we would try to be yeah.
On the employee front, even though last 12 months attrition has come down, what was the total net hiring this quarter?
So net addition to headcount was 122 in this quarter.
And that's entirely lateral?
Yeah, that's entirely lateral because the freshers came into the system a bit earlier, and the next batch will come, in 2023, mid of 2023 and so on.
How much you're planning to hire there?
So currently we are in the process of FY24 budgeting internally. And that's also partly because of the fact that most of the US-based clients make their budgets during this period. So once we have their plans available, we'll, kind of work on those numbers. It's a little too early right now to put exact number to that. But there will be a mix of freshers and laterals definitely in the next year as well.
Your IP services business has been growing handsomely quarter on quarter, 8.6% in this quarter. Do you expect to retain this kind of high growth for the IP services business?
So in the IP business, there is definitely a lot of opportunity. We have worked with large enterprise clients, and that is what has helped us grow on back-to-back 2 quarters. That said, there is a seasonality in this business where, Q4 happens to be a strong quarter. That is Q4 of the US-based companies, October, December quarter, where we have a little bit of a, bump up that happens. But now that we have what you call the penetration in, large number of enterprise customers who we are working with for these products, we do believe that, it's not very linear kind of a growth that this business could see. There will be some ups and downs here because of the seasonality and, the nature of these deals. But directionally, yes, definitely there is a good scope we find that we can build on this business and improve over a period of time.
Mhm. This quarter we saw a TCV which was around, if I'm not wrong, or ACV signings which were $326 million odd, which was there. Uh, it's something like a 1.7 book to bill kind of thing. Do you hope to retain this kind of ratio for book to bill going forward?
Yeah, absolutely. That is the, our internal kind of focus with which the sales teams are working. So, traditionally, you would have observed that in Persistence business, because we are on product engineering side, there is an iterative nature in product engineering, right? In terms of the agile way in which we work.
Hmm.
So it is not very easy for clients to kind of sign up very long-term deals in our nature of business. However, over a period of time, the clients who we have worked with, right, for more than 10 years, we are now able to convince them that yes, there is a capacity that we are able to commit to you for various products that you would like us to work on. And then, convert that into, instead of annual renewals, a little longer term deal, at least for 3 years, if not 5 years. Because their internal plans keep changing, and that's the reason they are a little shy, or they do not want to kind of write,
Hmm.
sort of sign up 5 year deals like other
Hmm.
situations. But if we are able to do that, what happens in the process is we are able to commit capacity, we are able to plan better. And then, the benefits of that kind of approach also, the clients see that yes, there is a, predictability of talent that will work on them. Because in this
Hmm.
business, it is critical to ensure that people who have been trained on the products of the clients, they bring that particular, cutting edge thought process to the client's environment, and they are retained. If you have an annual renewal and there is a gap, and the teams get released, so that's the kind of approach we are working with clients to convert this. So we do feel that yes, this book to bill ratio is something that we should be able to sustain.
How much of your total revenues today is long term, beyond more than 1 year contract? Have you been able to convince clients to go beyond 1%, 1 year?
Definitely, there have been, you can say, clients which have moved from very short term or 6 months, 1 year kind of renewal based kind of contracts. There are some OEMs or large ISVs that still follow annual renewal kind of a pattern, that we are not able to swim against the current, so to say. But there are a large number of companies, typically in, I would say, a billion to 2 billion kind of a range, that we work with, which are the companies where we are able to demonstrate that value and convert that. These may not be very large deals, but what it does is it definitely moves the needle in terms of our portfolio. And to answer your other question as to how much of this thing is longer term, so I would say that when we enter any year, we may have something like a 65% kind of visibility of revenues going into the next year. And out of that, about 35 to 40% would be of a longer term. And then the remaining keep getting renewed on an annual basis.
Mhm. And from a client perspective, how many would be more than 50 million or 100 million clients for you?
Yeah, so these numbers, more than 50 million, we have two clients. And between 30 to 50, also the number is going up. If you look at our fact sheet, I'll just tell you in a minute. So we give this in our fact sheet, how the client movement has been on the large clients. So if you look at the more than 5 million clients, we had that number as 17, at the end of FY21. Today, that number has doubled actually to 34. So that's the kind of, improvement that we have been able to do in the 5+ million clients. And if you want the little in between bucket, let me share that as well with you. Yeah. So if we look at 30 million plus, the total number is 5 clients. So as I said, 50 million plus are 2. So between 30 to 50, we have 3 clients. Between 20 to 30, we have 2 clients. And between 10 to 20, we have 9 clients.
And
So,
so the new orders which are coming in, in this quarter and in the last quarter, have you seen this being long-term, long-term approach by the clients, or is it a short-term discretionary kind of clientele which is coming in?
no, there is a fair mix, I would say. And in last 3 quarters, in each quarter, we have won a large deal, which is 5-year kind of term deal. So we do not necessarily see clients tending towards shorter term deals just because of the macro. But yes, the value proposition needs to be strong, and we definitely need to proactively work with them. These necessarily may not be, in an RFP mode, the way market is currently poised. So we have been able to craft longer term deals as well in this current environment. And we have had this, the fact that we had total TCV wins of 440 million this quarter. Definitely, it has to be done through a fair mix of the annual renewal kind of deals, the medium term deals, and the long term deals.
Finally, Sunil, can you give us an idea of what do you see FY24 looking like, given that your clients have completed their financials, and their IT spends for the next year would have already come in or are in the way, and you're already in discussion with them. How is our IT spends looking for your clients, and FY24 looking for you?
So, the early trends that we are gathering after the people have come back in the new year, that there is definitely an introspection internally in the clients' minds about the ROI on investments that they have already done, whether it is relating to digital transformation or cloud adoption and so on. So the next few quarters are going to be challenging as clients are tentative in terms of watching the macros, how the interest rates are going to pan out, how the energy crisis is going to settle down, and so on. So it is not going to be an easy navigation as we go along. But if we work very closely with the clients, the kind of sustenance of order wins that we have been reporting. So if you see our order wins where, say, TCV bookings were in the range of about $350-375 million in the last few quarters per quarter, that is the kind of bookings. Now we have crossed 400 million, for the first time. Of course, these are, quarterly kind of trends. For example, in October, December quarter, you have renewals happening, particularly for US clients. So it's not very easy to say that 400 is a number that we can sustain, but that will be the approach. And we have enough, in our kind of line of business with our ecosystem of the hyperscalers that we work with. While hyperscalers themselves are going through challenges, you would have seen in the market that there is a challenge about that. But so far as we are concerned, we are on the implementation side, and we are in the position of helping clients put, the best optimization or the cloud, you can say, what benefit they can derive out of this. To our mind, the benefit of benefit of what investments they have made is yet to be derived. And that's where we are continuously working with the clients. So from budgetary allocation standpoint, it may take maybe another 1 month for clients to freeze their budgets, because more questions are being asked about ROI particularly. But that's where we are, and we feel that we will continue to grow in the tough environment and be in the industry top leading, top quartile of the growth.
Sunil, it's been a pleasure talking to you today. Thank you very much for joining us on BQ Prime.
Thank you, Sajid. Thank you very much.
Thank you.